Welcome back to JC Project Freedom. Today, we are looking at a company that begs a massive question. Is this the most undervalued property stock in Asia? We are breaking down Hongkong Land, ticker SGXH78, currently trading at $8.33 when we were preparing this video. They are the operators behind some of the most premium CBD offices across Hong Kong, Singapore, and China. Let's look at the numbers to see if this deserves a place in the portfolio. First, what does Hongkong Land actually do? Their business is split into three main areas. The core engine is their premium investment property, or PIP. This comprises 450,000 square meters of Grade A office and luxury retail space across Hong Kong, Singapore, and China. The model is simple: rent it out and collect stable USD income. Second is their build-to-sell, or BTS, segment. This involves selling luxury homes in China, Singapore, and Southeast Asia. However, because this is cyclical and risky, it is currently being wound down and exited as part of their Vision 2035 plan. Finally, they have launched the SPREF Fund Management. This is a brand new asset-light platform where they manage real estate funds for massive institutional players like sovereign wealth funds and pension funds. Let's look at the FI 2025 results and the numbers you need to know. Underlying profit came in at a solid $458 million. More importantly for us as dividend investors, the DPS is US 25 cents, which is up 5% year over year. Their net asset value per share sits at a massive $13.57. Meanwhile, they've been cleaning up the balance sheet, dropping net debt by $1.5 billion down to $3.6 billion. This brings their gearing down to about 12%, which is a 10-year low. Keep in mind, this is all against a current share price of just $8.33. That brings us to the valuation disconnect. Right now, you're looking at a stock trading at a 40% discount to its book value, with an NAV of $13.57 and a price of $8.33. The price to NAV multiple is an incredibly low 0.61x. To put it simply, you are buying $1 prime Hong Kong real estate for just 61 cents. Historically, HKL trades between 0.5 and 0.8 times NAV, so the current valuation is hovering near a 10-year low. At this price, you lock in a dividend yield of approximately 3% based on that 25-cent DPS. And under the Vision 2035 plan, their goal is $10 billion in capital recycling, which should act as a catalyst that shrinks this discount. But why is the Landmark portfolio so special, and why can nobody replicate it? First, the location is absolutely irreplaceable. We are talking about 12 interconnected Grade A towers directly in Hong Kong's central CBD, where there is simply no new land available ever. Second is the switching cost network. Their tenants are major law firms, banks, and corporate HQs. Moving disrupts their client relationships, which drives a retention rate of over 90%. Third, the luxury retail cluster. The Landmark retail space hosts heavyweights like Hermes, Chanel, and Dior because these luxury brands absolutely need the foot traffic density that HKL provides. Finally, their Singapore cluster includes trophy assets like MBFC, One Raffles Quay, and One Raffles Link, which is Singapore's equivalent of a prime finance district. Looking ahead, management is executing Vision 2035, which is its overarching transformation plan. Step 1 is to exit the BTS segment. They are selling off residential assets in China and Singapore to stop tying up capital in risky property sales. Step 2 is capital recycling. They are targeting $10 billion over 10 years, and they're already 50% done in just 18 months, having sold off MCL Land and OES to HKX. Step 3 is scaling the SPREF Fund Management. This launched with 8.2 billion Singapore dollars in initial assets with QIA and APG as anchor LPs, turning fee income into a new growth engine. Step 4 is upgrading the PIP. They are sinking $1 billion into the tomorrow's central transformation to command higher rents and protect their trophy asset premium. Now, what could go wrong? We must underwrite the risks. The highest risk is U.S.-China geopolitics. Any severe escalation could drive multinationals out of the Hong Kong office market. Another high risk is the Hong Kong office oversupply. Currently, CBD committed vacancy is at 6.4%, which sits above historical norms. A medium risk involved the China BTS provisions. They took $371 million in provisions in FI 2025, and more are possible if the China market stays weak. Another medium risk is FX headwinds, where Hong Kong dollar softness compresses their USD reported rents. Finally, there is a low risk regarding SPREF execution. This is a new business model, and their fund management track record is still being built. Let's run this through the Engine A dividend scorecard. For leverage, our threshold for net debt to EBITDA is under 3.0x. H-scale sits at roughly 2.1x, so that is a pass. For dividend safety, we want the FCF payout ratio under 85%. They are at roughly 78%, earning a pass. For interest coverage, we look for EBIT over interest to be greater than 3.0x. They are currently at roughly 2.5x, triggering a watch. For pricing power, the gross margin trend needs to be stable or better. H-scale is stable, earning a pass. And for dividend growth, our target is a 5-year DPS to CAGR above 5%. They are at roughly 2.3%, triggering another watch. Remember, watch items mean the fundamental quality holds, but the price must compensate us for the risk. We demand a 30% or more margin of safety. So, what is H-scale actually worth? Running a DCF on owner earnings with a $620 million base, a 9.5% WACC that includes a 1.5% EM risk premium, and a 2.5% terminal growth rate, we get a base case of $9.30 per share and a bear case of $7.20 per share. Looking at the P/NAV multiple approach, with $13.57 NAV per share and a target multiple of 0.65 to 0.70x, the implied fair value is between $8.82 and $9.50. With a current P/NAV of 0.61x and a historical average around 0.70x, this blends out to a fair value range of $8.25 to $9.40. Since the current price is $8.33, the stock is trading right at fair value. Here is my final verdict on Hongkong Land. This is a conditional play. For example, I would establish a half position now and hold the full position pending geopolitical easing. On the plus side, it is a quality portfolio with irreplaceable HK and SGCBD assets that will still be standing in 50 years. The balance sheet is healing rapidly, with gearing at 12% and net debt down $1.5 billion in 12 months. The dividend is also growing, with the US 25-cent DPS marking a 5% increase, their first raise in years. However, because the $8.33 price is roughly at fair value, the margin of safety is simply too thin to justify a full position. The active tripwire remains US-China tensions, so we cap this at a half position until conditions ease. If you are investing for financial independence and found this breakdown useful, please subscribe for more deep dive stock analysis from JC Project Freedom. Drop a like to help the algorithm push this to more investors, and hit the bell so you never miss an analysis. I want to hear from you. Do you hold HKL? What is your thesis? Let's continue the conversation down in the comments.